This is the Wholesale Real Estate Masterclass, and you are inside of the automated profit machine. I'm here to hustle and motivate, and I want you to profit and automate. And we're gonna get to the automation part, but today we've got part 2. We're gonna talk all about getting properties for pennies on the dollar. So part 1, we went through a lot of the fundamentals of how to actually find motivated sellers, how to talk to them. We went over that in depth. If you did not see the part 1 of this video, please go check out part 1, because none of this other stuff on this video does no good if you can't actually get a seller to believe that you can help them solve their problem, and to have the seller sign the property over to you or agree to sell the property to you, so that you can then turn around and sell that property to someone else at a profit for yourself. So I advise you to go back and watch part 1 if you have not watched that, because I go in depth about how to talk to sellers and how to really approach the conversation, how to have that conversation, and really the fundamentals of also finding deals. So finding properties to invest in, looking up the information on those properties, who the owner is, how to reach out and contact those owners, how to put that process into place. And now we're going to really talk about the mechanics of the rest of the process once you have a property. And so we're going to do a little bit of review. And by the way, these are some of the courses that I have also taken myself. I have been on this journey for a very long time, and I have also stagnated at certain points in time and have gotten sidetracked. If you look at this Carlton Sheets course, the No Money Down course on the right, a lot of it talks about when you're making deals and not just making the deals, but you're also going to acquire the property, rehab the property possibly. So you're trying to figure out, if you look at how to get cash at closing and in other ways to skyrocket profits, and how to do creative deal financing. There's so many kind of like little rabbit holes that if you're new to real estate and you're new to investing, you can go down these rabbit holes, because it's very attractive to learn this information and figure out how you can be successful, when in fact there are some basic fundamentals that if you put into place, you will be successful anyway, and you will have sustained success because you're building a solid foundation. So before we get to tax liens and creative financing and funding deals and flipping properties and all the sexy stuff, let's do I remember the Cosby Show where the girls wanted to play drums, and they're like, I want to do chicka, and Bill Cosby was like, the teacher was like, well, they were mad upset because the instructor was like, they just wanted us to go thwack, 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 but I want to go jigga, and you have to start out going thwack, thwack, thwack. And and the point is in terms of real estate, if you put together a process that will allow you to get deals on a consistent basis, if you take the first funds you have, whether you have no money to get started, or you have some money to get started, or you have enough money to actually invest in properties. I told the story in part 1 of this video about my first deal, and the guy that I bought the house from actually was a part of the franchise companies, one of those buy houses franchises. And I realized, like, wow, this guy invested his first capital into gaining the ability to get customers or to get deals on a consistent basis. That was the first thing that he really built in his business. He wanted to make sure that he always had deals, and from there he can make all these decisions with that, because he always had deals. And that's what I want for you as we move forward. So as a wholesaler, you have 2 customers. This is what they call a middleman, and not a middleman in the sense that you're just in the middle taking profits for no reason. You're actually doing work. You are serving both sides. That's why you're in the middle, because there's somebody that is in some type of personal crisis right now, or they are a tired landlord, or some other something's going on, and they are really wrapped up and involved in their own set of issues, and they think that possibly there's no solution to their problem. They're not calling investors every day. They're not building relationships with cash buyers or anything like that. On the other side, you've got to picture your investor. He's riding, down the interstate in his Benz, and the AC is blowing cold, and he just stopped and, got some artisanal coffee, and he's loving his life. He went to the gym, and he's not calling stressed out individuals every day asking to buy their homes. So someone who is bridging that gap and solving the problems, because this same investor, if he has money, he has to have deals to invest in. Having no deals to invest in, he doesn't have an investing business. So you serve a purpose for this investor by bringing deals and presenting deals and opportunities for him to be able to use his money and make more money without using his time. And then you also solve the problem for someone who's in personal crisis, or they are overwhelmed with assets that they're having issues and difficulties managing. You are bridging that gap, you're bringing them together, you're solving both of their needs, and so you truly are the classic example of a middleman. So the first sale that has to happen, and this is just a slight review from yesterday, the first sale that has to happen is you have to sell the seller. You have to sell them on the fact that you can solve their problem and that you can help to get this property out of their hands and into someone else's hands, and do that quickly and effortlessly. So, and this starts in the first 4 seconds that you interact with the seller. They can tell as soon as they begin talking to you on the phone. If you're having a phone conversation, they within 4 seconds, they have kind of made this picture in their mind from the tone of your voice and the energy they feel of what kind of person you are. And you want to come off as sharp as a tack, you want to come off enthusiastic as hell, and you want to come off as an expert and an authority in what you do. And not an authority in terms of wagging your finger, police or boss or some kind of authority, but the authority in terms of you have integrity, and you are someone I can depend on, and you can help me solve my issue. And then one of the most important phases is gathering intelligence. If you are getting to the end of conversations or getting into deals, whether that be with sellers or investors or at your sales job, and you are getting certain objections because you didn't answer it or get questions answered way early on in the process, that is where you're going wrong in this gather intelligence phase. If, for example, I made a reference or an example in part one about how I just made up an example where the owner of the home had tried to sell the home in the past, and let's say for example the amount of work that the home needs, it needs a significant amount of work, and the value of the home just really isn't high enough for most investors to come in and look at that as an opportunity and jump on that deal. So so now this novice wholesaler comes by and he really thinks that he has an opportunity to go and wholesale this home. And so he goes and he does all this research, and he starts to call cash buyers and investors, and he's really excited because he thinks he has a deal. There's a seller that said, yes, if you can, if you can give me this much, I'll sell my home to you. And he goes and he does all this work only to discover that he can't get the deal done. And so he comes back to the seller and he says, hey, I can't get this deal done. I apologize. It just didn't work out. And the seller informs him at that point, and they're like, that's okay. I just really wanted to see if you could help. I had tried to sell the home before, and I ran into the same issue. That's the same thing the last investor said. And then you're like, oh crap. If I would have known this beforehand, I would have never wasted all this time doing that. If I would have asked this question earlier. So this gathering intelligence is an important phase, and if you're gathering intelligence properly, if you're listening to what this person is saying, you're learning about who they are and what's happening and the condition of the property, they not only begin to feel like you really are someone who is serious about what they do, they also begin to develop this rapport and this relationship with you. So it's respect and it's the relationship. That's really what rapport is. It's that combination of respect and relationship. And then you want to identify the real issue that is happening so you can actually bring a solution to that. You want to set their expectations about the process that is going to take place. And then you also want to, and also set their expectations about some adjustments that they may have to make in their mentality about everything. Maybe they're a little too emotionally attached to their home and they don't recognize that there's kind of a market value, and investors, other people who are going to buy homes have options, and if they're going to choose this option, then you have to kind of make it attractive for them and what that entails. So you're not just trying to take their money or make this profit off of them, but you're helping them understand that, you know, look, we're going to take an assessment on what has to be done to the home, and we're going to, you know, look at the comps in terms of sales in the area, and there's some other parameters. So, you know, we really, in order to make all of this work, we're just going to need you to be a little flexible, and then we can help you take care of this issue. So that is what setting expectations is all about. And then again, you want to be clear in the same, you know, in terms of setting expectations, you want to be clear about what will need to happen to get this deal done. And that way they don't feel like they're being duped, or you're pulling the wool over their eyes, or you're trying to get over on them or take advantage of their situation, because you have set those expectations and you were absolutely clear about what has to happen in order to really push this through and solve their problem. And then understand that objections, when you get objections, if you have done your job properly to this point and you're really now getting to the phase where it's time to really make a decision and commit to it and kind of be firm in what's going to happen and how we're going to move forward, you may meet some objections. And just understand that typically objections are smoke screens for uncertainty. But if people have objections and they're still willing to talk to you, if they have questions and they're still talking, that means that they're interested. So by all means, don't get flustered, don't get frustrated, don't get thrown off course when you meet objections. I think I just need to think about it. Well, it sounds good, but right now is just not the right time for me. But if you've gathered intelligence and you've helped them understand that, well, you've talked about this problem and how it can continue and what will happen in their life if they don't do anything about it, and you can help them, when they say it's not the right time, how do you know it's the right time? When is the right time? And if you ask that to them, you would come off as abrasive. But if you just understood that the reason why they feel like it's not time is just because they're just not really certain about what's going to happen and what the next move is and how all of this is going to work, or something of that nature. And so then, there's a process. I'll do some more videos on that about how to actually handle objections. I have a really good 6-step process to handle that in a way that's very non-confrontational, and it allows you to acknowledge what their objection is. You really get to work through them with it, but at the end of the day, you can help them see what the possibilities are. If they don't solve the problem, you can help them really walk into the possibilities of solving that issue and what life could be like, and then ultimately you're going to help them, ask them to move forward and take action. And then lastly, you want to meet their needs. That's what this is all about. And so if you can tell from their story that they really have a deep need to make this deal happen and it will really be good for them, and then you hear these objections, then you really will understand why you have a duty to be skillful enough to overcome these objections if that's what's really in the best interest of this seller. So that is, just a little review on actually, that whole process of selling and selling the seller, getting them really emotionally invested and the best solution for them. So once you sell the seller, then you have to go sell the cash buyer on why this is the right investment and why this is a good opportunity and why they should buy it from you. So we'll get to that here shortly. And these are just a few techniques in terms of dealing with people, matching and mirroring. That's where if the person is upbeat, you respond upbeat and you are energetic as well. But if the person is very laid back and kind of reserved and they talk like this, you want to make sure that you match that tone and mirror that, because that's also probably the way that they listen as well. And if you talk really fast and you talk like you're from New York, but they're from California, you may have a mismatch. So you just want to pay attention to people's styles and their tone and their energy and match that. If they have a real aggressive, assertive vibe and approach about their personality, they will probably feel like they can run over a wallflower. And and you may need to just kind of amp that up a little bit, and they kind of like and really relate to that aggressive feel, then you match that. If they really have a softer presence and a softer side, and then you are really abrasive and aggressive, you can really reach them in the wrong way. You want to again match and mirror how people are, their energy and their presence. And then there's the pacing and leading. So we talked about negative future pacing and positive future pacing, and where you help them really walk into the vision and the emotions of what life can be like in either situation, and then you lead them down the path that is most beneficial for them, and you help them see that and walk in a few of those footsteps along that path, again, so they can feel that emotional connection with what's going to happen. And then there's the concept of balance. If you're in a situation where the seller is kind of emotional, or anyone, and just right now, just not the right time, and I don't know if this is the right thing for me, and what you're saying sounds good, but I just don't know, now if you try to overcome that same energy at that point in the conversation, and you're like, no, let me tell you why this is the best, you won't reach them. If you balance that energy and say, hey, look, there's definitely no pressure here. I've got some other calls or other meetings that I need to go to myself. I just wanted to make sure that you had everything you needed to make a good decision. So when you feel comfortable, you just let me know. And then they go, well, I'm not saying I'm not going to do it. I tell you what, let me think about it. I'm going to call you tomorrow. Perfect, no problem. And so you use balance. And then if someone is just kind of agreeing with everything, okay. Well, then you have to be a little firmer and say, now, I know you said that you agreed to this, but are you committed? Are you really going to pick up the phone when I call? Are you really going to do this when I show up? Are you really going to be here so I can see the property? And you have to balance that passiveness with some assertiveness to really make sure they're firm and committed. And then the last thing is what I call actually I got this from my girl Michael, and Michael Smith, and it's called the egg timer approach. And basically it's that mentality that in a month, it's like you are boiling an egg and you're going to turn the timer to 4 minutes. And you want to just go through all the yeses and all the nos that you can before that timer goes off. And it doesn't matter, you don't get excited about the yeses. When people say yes, you don't get overly frustrated when people say no. You just know your job is to go through many yeses and nos as you can before that egg timer goes off. Now, you want to make sure the homeowner gives their offer first. And the reason for that is simple. Maybe you offered someone $50,000 for their house when they were willing to accept 40, and you just took 10 grand right out of your own pocket. And the reason why that's really important in terms of a timing or strategy and tactic is because most sellers don't know the real value of their homes. They're not familiar with the markets. They haven't gotten repair costs, obviously, because their home sometimes is in disrepair, or maybe they're just not experts in the field. And then they may not understand the whole process that's involved, and that an investor might go through, for example, getting a hard money loan to actually be able to purchase the property and make everything move. And so, but at the end of the day, they most likely will not have a good gauge on the actual. Well, I don't want to say actual value of the home. The value of the home is worth whatever somebody's willing to pay for it. So at the end of the day, that value just may not be in tune with what is commonly going to happen in the real world. And so you don't want to shoot yourself in the foot or put your foot in your mouth by giving your offer first. So let them give their offer first, And then now you can see where they are. Are they in outer space or are they in the ballpark? And that also lets you know what your course of action is going to be to reel them in. You know, are you going to have a tough heart-to-heart conversation, or do they kind of already get it and you can just move forward? And then lastly, you want to follow up. Continue to follow up. Situations change. And situations may change for the worse, and you actually, now they really need to move, and you are able to go ahead and get the deal for a lower offer. Now, you may feel a little uncomfortable giving these offers, but you want to focus on the fact that you are solving their problem, and understand that at the end of the day, the most important thing is to get this deal to move. And if you have done your job, then you deserve to get paid, because you have, like we said, you're in the middle. You serve the seller and you serve the buyer, so you definitely deserve to get paid. And you want to have that conversation, set those clear expectations, and just be really honest about what's going to happen. And then, you know, you may feel a little uncomfortable getting your offer, but give your offer. You know, and they can always negotiate, but you have got to give your offer and be confident that hey, this is you know what it's going to take to make this move. And then listen carefully and document everything that the seller says. And it's really impressive when you call back and you reference what you've talked about last time. Now they understand that you really do listen, you really do pay attention. And there are one or two things is going to happen. They're really going to value you as a person, because you have taken the time to care and remember about them. And they're also going to be careful with their words and about what they say. And they're going to make sure that they mean what they say, because you're going to remember it, and you're going to hold them accountable. Now, when you're actually giving this offer, you want to go to the worst part of the house, because you want to bring them in line with more of the reality that this is not a cut and dry situation. There's going to be some work that has to be done, and somebody has to invest their hard-earned money and hard cold cash in this property to help to alleviate this person's situation. So just, you know, that's just something that you can do to really tip the scales in your favor and make this property owner more receptive to what you have to offer. Now, early on in the conversation, just a little tip, sometimes you'll talk to someone and they say, hey, the property doesn't need any work. You know, you can just ask them, you know, simple questions. Does it need cosmetic work? But here's the question that I actually really like to ask. And it's, well, oh, that's wonderful. I'm glad you've taken care of your property. Let me ask you this. If you were going to put your property on the market and sell it for top dollar, I mean, you wanted to get the most that you can get for your property, what improvements would you make? Well, maybe I'd paint the outside, and there is a little crack in the down there in one of those rooms. I fill that up, and so now you can at least start to ask questions, get them talking, and really, you know, get a honest answer on the condition of the home before you go see it, or if you want to decide to go see it. And then lastly, you want to advise the owner that you can close quickly. Let them know that you can alleviate this situation and get this taken care of, get this closed, get them cash in their hands quickly. Now, what you want to have happen throughout this whole process is you establish and maintain control from the beginning. And I can't say enough about gathering intelligence. That is really where you build this foundation for what's going to happen throughout the rest of this process. And if you don't build a strong foundation, if you don't have legs to stand on, it's really easy for the homeowner, the seller, to kind of tip you over and find reasons why they should move forward with you. And then you also now want to use always a purchase and sale agreement after you've gotten to a certain point. Now we're about to get into the part where we use agreements. And again, you set this phase of the situation up all the way from the beginning, especially in this gathering intelligence phase. And now you can move to the purchase sale agreement. And so one of the ways that you can move into this phase and have control and do it very, very smoothly is to simply say, okay, so all you have to do is give me your authorization and let's fill out this agreement together. And then your job is done. I'm going to take this from here. I'm going to go and take care of everything with the title company. I'm going to arrange the sale. I'm going to make this very easy. So you want the seller to feel like they just have to put a little bit of energy in and they get a lot of benefits out. And that is how you maintain control from the discovery phase, where you're gathering intelligence and finding out all about this person and this property, through the actual phase where you're going to now start to work into the agreements and actually get firm commitments. So you want to be able to move through these phases smoothly, and you want to be able to maintain control all the way through the process. So this is just a little picture of a purchase and sale agreement. I have links to the agreements, copies of agreements that you can have, and I also have just like some JPEG pictures that have basic instructions on how to fill the purchase and sale agreement out. But essentially, you want to put the buyer and the seller on there, of course, and you want to use the property and address description that comes from the tax assessor or the county website, where they actually have the actual description for the house. You want to use that on the property address and description, and then of course the purchase price of the home and any other details that, again, you'll have those instructions in that picture that you can download below. But other than that, you basically are filling in all of the blanks and the items that are included. So from the closing costs and who's going to cover those, the seller or the buyer, and other things that go along with the actual contract. So again, here's some basic tips. You want to and if the property's in an estate and not in a person's name, then you just put the name of the estate. And if the property's in multiple names, you want to make sure that each name is on the contract, and also understand that every person is going to sign that contract. And if the owner has appliances and you want those appliances, or other little things like that, you want to state those in the agreement, that hey, this goes to me, or someone else is going to keep that with them. You want to put those in the agreement. You want to put clauses in your contract that are going to protect you. So a lot of times people worry about getting stuck with properties. You can put clauses in there that say, hey, look, if I'm not able to sell this property in 30 days or 60 days, or however long you want to give yourself, that you don't hold me liable. You can put those types of clauses in there, because at the end of the day, you want to basically promise that you are going to help out as much as humanly possible. You're going to do all you can to get this property moved, but you don't at all want to be overly obligated in terms of, well, you said you were going to buy this property and you didn't. So you want to put these things in there, and now you're getting again into the parts, the real details of the conversation. They may ask you, for example, like for example, I'm about to say you want to put the closing date out as far as possible. You definitely want to let them know you're looking to close sooner, but you want to give yourself time, and they an astute, someone who pays attention, they're going to ask you, well, you said you can close quickly. You said 7 to 10 days. Why are you giving yourself 90 days to sell this property, or 60 days or 30 days to sell this property? And you simply let them know that, look, in most cases I close in 7 to 10 days, but sometimes there are issues that happen. You never know what is going to happen with what comes back from the title company. There may be some other issues that come up that we don't know about until we actually really get deep into the research process about the property and the details. And so if something like that happens, and let's say we set this agreement for 7 days, and we had a snag with the title company or some other process, and we had to reschedule the closing, we're gonna have to go sign all this stuff all over again. And so it really would just be a lot easier if we give ourselves some time and some room for any of that to happen. But of course, I'm looking to close in 7 to 10 days. And then lastly, the one I skipped over again was putting the legal description from on the contract that comes from the tax assessor, even if it's long. All right, now you got a signed contract. Excuse me. So now we want to take this contract right to the title company, and you want to find an investor-friendly title company, someone that routinely does double closings and wholesale closings. And you might not be doing this right now, but ask them if they do subject to deals. These are the types of title companies that you're looking to work with, because they will help you execute this process smoothly and make sure that you get this pushed through and you get your money in the end. And so you want all of this to be recorded by the title company, and that they ask you, that EMD stands for earnest money deposit. So if they ask you for a earnest money deposit, you take that to them. And then, sometimes you don't have to, but if they do, you take that to them. And now that you have gotten this contract signed with the seller and you have got it recorded at the title company, it is time to get this show on the road, and let's close this thing, and we're gonna find a buyer. We're gonna find somebody to come take this property off the seller's hands and leave you with your profit. So now we're gonna cover the importance of a cash buyer, the traits of a cash buyer, what is a good deal for a cash buyer, 7 strategies you can use to find cash buyers, and building a cash buyers list. A cash buyer is someone who will purchase the property you have under contract with the seller for all cash. We don't want 30 days to get financing from the bank. We don't want terms. We don't want conditions. We want all cash as is. That is what we are after. So that's what a cash buyer is, and that's what we want. We want someone who's going to pay you for your deals. We want someone who buys houses and fixes them up and then resells them. That is typically an investor, like a fix and flip investor. Or you want someone who buys houses and rents them out, like a landlord, or someone who owns a portfolio of properties. Here's why cash buyers are important: because you don't get paid without them. You cannot sell the property. Well, I mean, you can, but it's a much different process than, hey, here's cash and here is the money, and you got your cut out of it, and everybody is able to walk away from the closing table. That is, it's a much different situation if it's not a cash transaction, and that's what you're looking for. That's what you told them when you said that you would close in 7 to 10 days, because other real estate transactions that aren't all cash closings do not happen in 7 to 10 days. And so remember that you have 2 customers. You have to sell the seller, you have to sell the cash buyer. So your personal mission here is not complete with both of those ends. And so without the seller and the buyer, or without the buyer, basically, you still don't have a customer, because you have to complete the transaction. Now, excuse me, as I talked about gathering intelligence and qualifying sellers. You want to go through the same process with the buyers. What you don't want to have happen is, what you want to avoid is, you want to avoid any situation where someone is, in either way, where the seller or buyer, but now we're talking about buyers, you want to avoid a situation where somebody is a looky-loo or a tire kicker. There are so many investors out here that want to play investor, in whether they're on the side, they're forever on the sidelines, and they're always learning and trying to find the quote right deal, or they want to just feel like they're an investor and they feel the power of saying no, and well, yeah, I'll take a look at it, but no. And so and when you put a lot of time and energy and effort into getting to this point in the process, then you don't want to be jerked around. You want somebody who's going to be for real with you. And the reality is, real investors, real people who have money, they respect time, they know what it takes to get money, and they don't have time to play themselves. And so sometimes it may seem a little intimidating to approach investors, to approach people with money, but that's really the best of people to approach, because if you're serious about what you do, they're serious about what they do as well, and it's not going to be a whole lot of time wasting. It's just not going to be a lot of that. people, at the end of the day, if you're, really somebody who wants to get things done and you're a productive person, it's in your best interest to see things move and to see things happen and to see things flourish. So just understand that. So don't be afraid to qualify investors. I don't care if you don't have a dime to your name. You are working, you don't want, and you can't get a dime to your name unless you can do something of value. So somebody wasting your time doesn't help you in that process. Don't be afraid to qualify them. Don't be afraid to ask questions and gather intelligence, because you want to make sure that you can move forward and you don't have these hiccups. And so again, just really be confident and comfortable in the fact that I don't care what color you are, real people who serious about what they do in money, they really don't care about that. They might not have a bunch of friends that are like you, but it doesn't matter. If you're bringing value to them, their ears are open, they're willing to listen, and because they can get something out of it, and that's what counts. So with that being said, one thing that you want to know from a cash buyer is that you want to know their investing criteria. Everyone is going to be different. Different investors at different levels, from someone who's actively looking for their first deal, someone who's doing a few deals a month, someone who's looking for more properties for their portfolio, or someone who invests in luxury properties, someone who invests in apartments. There's so many different things you can invest in. Some people just buy notes, some people buy liens. There's just so many ways to invest. So but as far as like single family homes or even apartment buildings, there's certain, like say apartments, there's class A, B, C, D apartments. Some investors only invest in class A apartments that are managed by funds. Some investors invest in class C apartments where they can find or more likely to find or be in contact with the single owner of the property or the apartment complex. And so there's just, again, a lot of different levels and criterias and styles and all these kinds of things. In terms of single family homes, some investors only like to do buy in certain areas. Some investors like to buy duplexes. Some investors like to buy, like I said, luxury homes, and some investors like to buy the homes that they know they can rent. So you have to just really, get out, and you don't want to be stuck and turn into one type of investor. It's best for you to build your network, get as many as you can, because what's going to happen is as you get actively involved in this process, you're going to start coming across deals and opportunities. You'll just hear about one. Maybe you're talking to this person and their situation really isn't right to buy their house at such a deep discount, but they're willing to do something. They're willing to sell their home, or maybe this is a landlord and they're not willing to do this all cash transaction, but maybe they're willing to take some down and hold a note or whatever it may be. But the point is, they're still a motivated seller and they're willing to be creative. You don't have to know the answers, but if you know the investor who will invest in something like that, there you go. Now you can pass that on. And so just make as many connections as you can, but you want to know what their investing criteria is. So what their budget is, how much do they invest, what is the price range, the values that they typically look for, what type of upside do they typically look for? Are they buy and hold and they don't need a lot of profit margin? I want to use one of these jargon words, but are they looking for a lot of appreciation is really what it's called, where the home has potential to increase in its value, or does it matter? Do they I just want something that I can get in and I'm going to get stable rents? Do they like certain markets, certain geography, certain parts of the city, certain property types? What's their experience in investing? One of the best questions that you can ask is, when's the last time they bought a property? I've never bought one. I bought one 5 years ago. I buy properties every single month. You want to know that, and that also helps you know how serious they are. And then lastly, if it's an investor that you've never done business with, and you have a deal on the line, you might want to ask them for proof of funds. So that way, hey, look, I've got 3 or 4 investors who are interested in this one property, and I just want to make sure, before I send this over, that you really can move on it because it's going to happen quickly. So do you mind sending me a letter, that has a proof of funds from the bank or something like that? And they shouldn't have any problem doing that. Here are some traits of a cash buyer. They actually have cash. Now, there are people that got cash, so don't get me twisted. But what you also have in a lot of situations are investors that have access to what's called hard money loans. And those are lenders who are willing to invest, or excuse me, not invest, are willing to lend the investor the funds that are necessary to acquire a property, rehab that property, and it's usually a short-term loan at a higher interest rate. High is relative, or some higher, some lower, but it's definitely higher than what you're going to get at a normal bank. So the investor is going to take this property. They're going to look at the ARV, the after repair value of the property. The hard money lender is typically going to loan 70%, up to 70% of the ARV. So in other words, if the home is the ARV is $100,000, the hard money lender is willing to loan the investor $70,000, so they can go and that they have to go use that $70,000 to buy the property and to fix the property up. Now, the investor is expecting to flip that property. So let's say, let me give well, we have the ARV, so we know that the value is $100,000. So in other words, the investor is going to go get this loan for $70,000. They're going to go buy the property. They're going to fix the property up with that $70,000. Then the investor is going to turn around and sell this home for $100,000. And then the investor is looking for that $30,000 of profit. And yes, they're going to have, and they're going to have to, pay some interest and everything, but they typically have factored that in. So at the end of the day, the investor is looking to go get this loan, acquire this home with somebody else's money, not his, and manage the process, complete the rehab, sell that home, and then get his profit. And so that is what this investor is looking to do. So all investors are not just cash investors rolling around with a few $100,000 in their pockets. A lot of times they are, even if they do have that money, when they say 7 to 10 days, that's typically how long it takes to go get a hard money loan lined up for them to go look at the property, approve the loan, and then issue those funds so they can acquire the property. So that is typically how, a lot of times how that can happen. And a lot of times this proof of funds letter might be a letter from a hard money lender, not necessarily a bank. So this is kind of just some insight on how that process actually happens. And then you also want to go and make as much contact with hard money lenders as possible. That is I don't really hear a lot of people talking about that, but in my opinion, that's an excellent source of cash buyers. Because think about it, the hard money lender is in the business of lending money to investors. And what do investors need in order to borrow money? They need deals. So there's no hard money lending, there's no interest if there's no deals. And so the hard money lenders, what do? They lend money to who? Investors, who are cash buyers. So the hard money lenders, and you can just Google them, are great sources of cash buyers. A lot of hard money lenders, in any business, you'll see there are some people who really understand how to put themselves out there and communicate, which is called marketing. But they understand that process of how to do that. So some of these hard money lenders will host meetups. They might have like free classes at their offices to teach people how to use hard money to invest in real estate. They might have blogs and all these different things where they are gathering these groups of investors and buyers. And so is it best to go use all these other avenues to find cash buyers? Or if you could go to one source and find 10, 15, 20 cash buyers, it's best to go to that one source and find them. So that's definitely a good place to go. And then you want them to provide a non-refundable deposit of $500 to $1,000 up front. And you also want an investor that does not care how much money you're making. They're not in your pockets. They're only in their pockets. In other words, you're presenting them with a deal, and it's either a deal or it's not. It does it make money for you or not? Here's the deal. Take it. Go do your analysis. If you want to move on it, let me know. And if not, I'll send you another deal next week, and you can look at that one and let me know what you think. How much money I'm making don't even matter. You know, I wish I could think of I hate when I want to think of something off the top of my head, but oh yeah, you know, like Jay-Z said, y'all don't know my expenses. I got to buy a bigger place and more baggies. You know what I'm saying? Y'all don't know my expenses, okay? Look, investor, you don't know my expenses, man. Listen, same thing to the seller. They're going to look at this contract sometimes, and I do have some ways around that. But if they sometimes are able to look at this at the agreement at the title company, and they see how much money you're going to be making, they might be upset with that. But look, man, y'all don't know my expenses. Y'all don't know that I'm trying to buy a bigger place. You know, y'all don't know that I put ad dollars out so I can make sure I get more deals. So Mr. Investor, you know, I actually, you know, I invest in my business so I can provide a service to sellers, so I can provide a service to you. And if I'm not able to be profitable on my deals, I don't have a business. I can't serve anybody. So you don't know my expenses, man. You know what I'm talking about? All right. So what is a good deal? Now, there are, again, different types of investors, different types of cash buyers. You have fix and flips. You know, just in general, you got your fix and flips and you got your buy and hold. The fix and flip investor, again, either whether he's using his own cash, he's looking to make a profit, or if he's getting a hard money loan, he can only borrow up to 70% of the ARV. So they have to buy this property at a deep discount to make it all work, to be able to acquire the property, to have the money to fix it up, to be able to actually sell it and make a profit for themselves. So they have to buy it at a deep discount. The buy and hold investor will sometimes be willing to buy at a higher price because they're just looking to get income from the property. The fix and flip investor might have this property for like anywhere from 3 to 6 months. You know, in the best case scenario, 3 to 6 months, they acquired the property, got the project done, and sold the property. And so they're looking to make this capital gain. They're looking to get, you know, this $30,000. Whereas this in the example that I just gave, whereas the buy and hold investor is like, well, I know I'm going to be making $1,000 a month, and I want to buy this property for the income. So they're, you know, so they're really concerned about the cash flow, not necessarily how much room they have for the value of the property to go up and make this profit. They're really concerned about the monthly cash flow. Now, I'm going to give you another golden nugget, okay? We talked earlier, I mentioned that what you want to do when you're searching for properties and searching for zip codes is find the properties, or excuse me, find the zip codes where there was the most activity in the last 6 to 12 months. You want to just find the zip codes where properties are moving, because that is where the investors either are or where the other investors want to be, because the properties are moving. But why are properties moving? It's not just numbers, it's not just data. You don't just go look this stuff up. This is people. At the end of the day, all this stuff is people. What are their problems? What are their needs? What are their habits? What are their desires? All this stuff. So what is going on the ground and inside of people's lives, inside of society, inside of politics, inside of the city plans, inside of certain developments, inside of, you know, what is going on that is causing people to move around, to have shifts? Is there, you know, these are the things that you want to look for. Now, in terms of actual numbers, you want to locate variance. That's the golden nugget, is locate variance. When I say variance, that means things are varying, they range. And so what you want to find is when you are doing your comps, at the end of the day, you want to take it to the price per square foot. And I'm going to show you an example of that later on here in this video. But you want to boil everything down to price per square foot. You don't want to just go, okay, the homes in this area are selling for $250,000. That's a good general way to look at everything, but you're going to miss some things and leave money on the table when you do that. What you want to do is break it down to price per square foot, because then you'll see that you'll see sometimes that you can make a much bigger profit that way, by pricing the home that way. You can help to explain the comps better, and you know, there's just a lot of advantages to that. But I don't want to get sidetracked. But what you want to look for is are basically a big gap, a big spread in between the price per square foot that homes are selling for. I mean that homes are being bought for, and then what they're being sold for. So let's say, for example, again, regardless of the home values, right? Just square foot. Let's say there's an area of town where homes are selling for $55 a square foot, or excuse me, I'm sorry. Homes are being bought for $55 a square foot, and then they're turned around and being sold for $65 a square foot, okay? Whereas in this other area of town, homes are being bought for $35 a square foot, and then are being sold for $75 a square foot. Which place would you rather make your investment? Exactly. You want to invest where you can buy a home for $35 a square foot, and you can sell that home for $75 a square foot. And you know, when you just look at prices, it's much harder to do that. And sometimes I just be talking. I didn't even see this example here. I already got say it's going 25 and 50. I just really see this stuff when I start talking. So yeah, let's say, you know, you can go buy probably for 25 square foot and sell it for $50 a square foot. That's basically what you want to do. And if you can identify those areas of town, you know, a lot of people just look at home values and they don't see it that way. But when you break it all the way down into the value per square foot, you really see these numbers pop out and they start talking to you. And those are great motivating factors to get investors on board. Those are the areas that you want to find and where you want to be in. And lastly, you want to keep your ear to the ground because you want to pay attention to what's going on. Did a major company shut down? Did somebody relocate? What's happening that's driving all of this? And then, you know, again, for the fix and flip investor, remember that in order to sell the property, in order for him to buy the property, it's got to be at a certain price, just all the way around, because a lot of times they do get these hard money loans, and it's 70% of the after repair value, and then so you got to figure out what those numbers are, and they have to. And in the hard money, a lot of hard money lenders will walk the properties before they loan money to these investors, and that's who ultimately is going to be setting the terms. So if the cash buyer has his own cash, he can make his own decisions. If he's getting a hard money loan, the hard money lender really ultimately is the one who's making the decision. And so he's going to have to follow these guidelines, or she's going to have to follow these guidelines from the hard money lender to make the deal work. And so just understand that is the parameter, that's the limitations that some people are working with when they're looking to invest in properties. Now, the buy and hold investor will take a deep discount, but they also will spend a little bit more. And not only are they not looking for as much appreciation, but they are also not going to go overboard on repairs because they just want to rent the home. And so basically, what you can do to find the sales price is you can take the after repair value for the fix and flip, take the after repair value times 70% minus the repair, and that's going to get your sales price. And then, well, that's going to be his sales price. And then same thing for the buy and hold, but he's going to take the after repair value times 80% minus the repairs, okay? And that's going to be his sales price. Now, here are strategies to find cash buyers. Bandit signs are a very effective way. And you can just, advertise your deal. Hey, I've got a 4-bedroom, 2-bathroom home, $25,000, or probably I will say $100,000 or something like that. That's not the right price range. But the point is, you can basically just put very basic details of the deal, and and you can find cash buyers. Now, a good place to put these bandit signs is on busy roads that are close to Home Depot and Lowe's, and you want to put these signs where they're leaving. So they just came to Home Depot or Lowe's, they loaded up the truck or the car, whatever they've got. They went and bought some new fixtures, or they bought some lumber, and some bricks or cement, and they're off now. They're driving down the road, and oh wow, here's a new opportunity I can invest in, or here's a new opportunity I can tell somebody about. So you want to be strategic in turn, because all these people are going to these places to get these materials and supplies. That's where investors go and and hang out. That's where contractors go and hang out. Contractors are connected to investors. So you want to put your deal in front of these people. You can also go on sites like Craigslist or Backpage or Facebook. You want to post at least 3 times a day when you have these deals, because these are opportunities. And you want to put the address, the ARV, and the asking price. That's at least the basic information that you want to have. And then you could also go to the tax assessor's website and do it depends on which state you're in, which information is available. But you can go to the tax assessor's website. You can look for property searches, but also do a sales search to see what's sold in the last 6 to 12 months, and especially in the last 6 months. Now, I used Dallas, Texas before, but the same information isn't available on the buyer side in Dallas. So here we're gonna look in Florida. So this is Hillsborough County, Florida. And basically, we went to the property assessor's website, and we're going to click on property search. And then you're going to look on sales search, okay? And then you're going to pick the property type. In this case, we're looking for single family homes, and we want to go back 6 months on the date, okay? So we want to go back 6 months and see who has bought in 6 months. And then now you're going to click search. And then you look and you're going to see all of these the listings that come down, okay? And when in terms of just knowing who really is your most likely prospect to be a cash buyer, you see these companies, these LLCs that have been incorporated, because these are holding companies or the companies that these people are using to own these properties. And they are investors. They're definitely investors. And you actually can see that they have bought more than one property. They bought quite a few properties, actually. So this is a pretty active, the CCP fund. And then you've got C Holdings. So you want to find these LLCs, and these are these are cash buyers, and you can get their address, you can send them information, and there you go. And then some other strategies are you can go to meetups. The RIA meetings, the Real Estate Investors Associations in different cities are great places, and then also networking. Now, one thing about meetups and RIAs, they're definitely good places to find serious investors. They're definitely good places to get educated on real estate. But be careful that you will get a good deal of looky-loos and tire kickers at these meetings, because these are the typical people who are going to learn, and really be slow to take action. And so this is a nice, safe environment for them to really kind of feed that desire that they have to learn and be around and involved in real estate to some degree. But you're going to find some people who will honestly waste your time, because they're just, they're not serious. They just want to be involved and around, and they learn a lot. But actually taking action and moving on properties, hey, here's a property, what do you think? Okay, yes, I'll take this deal, I'll move on it, I'll get it done, no problem. You have to, a lot of times, those might even be the people that are presenting at the meetings. So that's what I'm saying. It may not be everybody that's sitting in the room, because people are at different levels. Some people are learning, some people are just have been learned, and they're not going to take action. Some people are serious. And then you've got the people who actually organize these meetings and run these chapters. And then you have the people who come and present. All of these people are definitely serious. And so, for example, one of the reasons that people facilitate these things and run these meetings is so they can develop this network of people. That person who these people who are really involved and actually run these local associations, they are some serious people. And because they're in the business of getting people around them who they can do deals with, and they're active with it. Those are definitely good sources. The presenters that come by and that speak every month at the meetings or that do special courses or presentations, they're serious. You want to get to know those people as well. And so RIAs are definitely a good source, but again, you have to just be wary and conscious of who you're talking to and making sure that they're serious and they take action, but they're definitely involved. And then also networking, just letting people know that, hey, I'm an investor, I make things happen, I solve problems for people, and I'm looking to buy properties. So yeah, I just talked about the RIA. Another thing that you can do when you join the RIAs is they typically will have a list of opportunities of deals, and you can take your deal and you can email it to the whole membership. So everyone that's a member will basically see that, hey, you've got a deal, and you can find some cash buyers that way. And then you can also look for, like I mentioned, hard money lenders, Googling them. Same thing with the We Buy Houses type franchises in every city. Google those, and then when you Google those, the search results that you see at the top that say ads, those are paid ads. That's different from the results you see a little further down the page, which are the organic results. That's just like the organic results are just the results that Google will bring up that are most relevant to what it thinks you're looking for. So Google thinks you're looking for We Buy Houses in your city, and they're going to bring you the results that they think are closest to what they think you're trying to find. The paid ads are people who are paying to be in that spot. They are active. They are looking for deals. That's why they're paying to put their name out there. Call them. They are good sources of cash buyers. The realtors will definitely send you lists of cash buyers. They are in the property of helping people make transactions, and if they can help you find people to sell properties to, that's in their best interest. And realtors really are investor-friendly realtors are great people to have on your have in your circle or on your team, and they can definitely help out. And then you can also work with other wholesalers. So let's say that I have a property, I got a deal on it, I don't have a cash buyer, but this other guy who's been wholesaling for 15 years, he's got a whole list of cash buyers. I can just partner with him and split the profits and say, hey, look, if you bring me a buyer to buy this property, I'll split my assignment fee with you 50-50, no problem. And they will, a lot of times will do that. And then you also want to be building your list over time, and then you can always send email and text out to your list every time you bring a new property on board. Another thing that will help to move your properties, that will give you a lot of credibility with the buyers and everybody else, period, is packaging your deal. So you can put, just the bandit sign out there, but ultimately you want to package your deal, and basically you want to present it in a way where they can get the most important details about you, about the property, about what you plan to do, and then that will help them understand what the opportunity is. And so, here you can see where the information is here, and everything that they need to from the ARV, the purchase price, the rehab costs, everything is here to help them understand what is involved in this property. And now here's where I'm talking about, where I was talking about going to the price per square foot. Now, I was looking at the house that I had. This house here was a 2-bedroom, 1-bath house. Okay, and so I looked at other 2-1s in the area that had sold, and I got the most recent that I could find. And look at the range, okay? And so these weren't very expensive houses at all, but still look at the wider range from $42,000 to $60,000, okay? And the $42,000 home was $81 a square foot. The $60,000 home was $34 a square foot, okay? And then so now I'm looking at this and I'm like, wow, where should I price this home? Should I just say, well, it's like this home, let me do 40,000, or should I say, well, this home is bigger? You know, how do I figure this out? Well, when I got down to the price per square foot, I can just really honestly kind of play with the numbers a little bit. Okay, so while this home is just a little bit bigger, it's the biggest home out of all three, and but at the end of the day, you know, I was able to kind of really find what I thought was a comfortable price by playing, you know, so I took, you know, what is that, $50 a square foot? Well, I don't think that's enough. Well, what does it look like at $80 a square foot? Well, that might be too much. And I just kind of played with it because I had this reference in terms of price per square foot. And that's where you can really fine tune how much you think the home can be worth. Now, even if you don't have this whole list of cash buyers, if you have a deal, they will come. A deal is a deal. The value is in the deal. All experienced investors know this, and they look for deals. They know that the deal is made when you buy. And anybody that has a pulse that says they're an investor can recognize a good deal when they see it. So you don't have to worry that you don't have this huge, large list of investors and you've got to go get a list of cash buyers together before you get started. No, you have to find the deal. And if you find the good deal, if you build it, they will come. Just like these guys, you know, this was a movie back in the day. This guy built this baseball field in the middle of nowhere in Iowa, and, you know, everybody thought he was crazy, and, you know, who was supposed to come play baseball? Well, here were these guys were kind of like spirits or whatever, you know, and they would walk out of the cornfields and come play baseball. And, you know, so this is just what it looks like when you find this deal. You're going to see investors walking out of the weeds, walking out of the cornfields from everywhere trying to get on this hot deal that you have. When you go and approach all these investors like, hey, I'm so-and-so, and this is what I'm going to do, and I'm going to go find deals, and I'm going to email you when I find a deal. I just wanted to, you know, to talk to you and, you know, and learn more about you and what you're looking for. That's one level. Okay, cool. Sounds good. You know, here's what I'm looking for. Here's my criteria. Here's my information, blah, blah, blah. But when you're like, hey, look, I got a deal. Here's the details. Here's what's happening. Do you want to move on this? People, you know, especially these investors, they respond to that assertiveness, and that's why you don't, you know, when you're just setting things up, you know, and everything's setting things up, you know, they don't really take you seriously. Because at the end of the day, it's the action that's going to tell it, right? So if you are taking action and you're moving, they'll take you seriously. So when you find this deal, trust me, they will come, because now you're talking turkey. Now you're, you know, like, hey, look, well, what are the numbers, and what are the ARV, and what are the repairs, and what happened? Well, talk to me about the seller. Like, now you got a conversation, and so even if you've talked to one person, it's going to be a much more meaningful conversation than 100, you know, gathering, you know, basic information conversations. So don't spend your time trying to get this list of 100 people that you talk to casually because you were just building your list of cash buyers. Go find this deal and then find your list of cash buyers, okay? Find the deal first. So now you found a cash buyer. What do? Well, now once we agree on price, we fill out the assignment contract, okay? The assignment contract is the contract where you're going to, so you have this agreement with the homeowner that they're going to sell this property to you, but you're not going to buy the property. You're going to, so what happened is they're basically giving you the rights to buy the property, okay? So the seller is giving you the rights to buy the property. They're not going to sell it to anybody else. They gave that right to you when they signed that agreement for that period of time. So you now, instead of exercising that right, you're going to assign that right to someone else to exercise, because we exercise our rights. So once you assign that contract over to the cash buyer, they're going to exercise that contract, they're going to close on the property, and then you get your fee for assigning that contract at closing. But you have to make sure your assignment fee is on the HUD 1, okay? And you can see where the arrows are. That's the line where your assignment fee is going to go. Shout out to my boy Dominique Royal. He already kind of had this diagram done up, so I just said, hey, I'll just use that one, and so everybody can see what it looks like in the end. So you can see where his assignment fee was included on the HUD-1 statement. And so again, make sure your fee is on the HUD-1. That's what it looks like. The HUD-1 is the closing statement that is used in real estate transactions. Now, there are different types of closings, for wholesale deals. There's a traditional wholesale closing, there's the double closing. The traditional closing is when the cash buyer brings their money to the deal and pays you, the wholesaler, and the seller. Well, basically, they buy the property all at once. So you know, you've assigned the contract over. Everybody's coming to closing. The seller pays for the property, and then now the title company is going to issue your check and their check to the seller. So the pros of this is that you basically just got one closing, one transaction, and so you have no extra fees. The cons of this is that all the details of this closing are going to be listed on that HUD-1 statement, because it's going to list out everything that has to happen. And so the seller is going to see exactly what you made on the deal. Some sellers are cool with it. Some sellers kind of have figured it out in their brain already. Other sellers had no idea, and when they find out that you made $20,000 on this selling their house, and they only got $10,000 for selling their house, they are not gonna like it. So here's what you do. You ask the title company to do a seller side only closing, with the seller side only HUD-1, excuse me. And that is a traditional wholesale closing, but you're requesting for the information to be one set of information to be on the seller's HUD-1 and the other set of information to be on the buyer's HUD-1. So only the information that pertains to them is what's going to be on the HUD-1. So the seller is only seeing what's on their HUD-1, what pertains to them. This is what you get. You get this money back at closing, you know, blah, 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 blah. And then same thing for the buyer. He has all of his information, your assignment fee, that's on the buyer's HUD-1. So the pros is that the seller cannot see what you made on the deal, and I can't think of a disadvantage to that, of a con to that. And so that's again another advantage of working with an investor-friendly title company, is that they be willing to do things like provide you with the seller side only HUD-1. Now, a double closing is when the wholesaler acts as the buyer on the first closing in one room, and then you go immediately to the other room and you sell the property to the cash buyer. So this is, again, is going to happen at the title company. So the seller is going to be in one room, and he just signed the contract and you, quote, purchased the house. But then in less than 2 minutes, you ran down the hall with your hot contract and you sold this hot contract to the buyer, because you know you want this hot potatoes, get it out of your hands. You didn't come with the money, so you need to go to the buyer and have them buy it from you. Okay, so so that's basically how double closing works. You're buying it from the seller, but then you're immediately selling it to the buyer. So it's going from the seller to you, then from you to the buyer. And now the pros is that you only own the property for a few minutes, and sometimes you can use the buyer's money to do that. So you can't just like say I'm closing on the property. You actually have to have money. So sometimes the title company will allow you to basically, you know, the buyer sitting in the same room, the money's there. They will allow you to, quote, use the buyer's money to buy the property, and then you can sell the property to the buyer. So, and because he's already kind of paid for it. So you just, you know, so that's how the title company does that. And then the cons is that sometimes, like, since technically that's not how it's supposed to work, the cons is that sometimes you'll have to actually use a hard money lender and pay a fee to use their money for like 30 minutes, you know. So you use the money, the hard money loan, you got the $70,000 to buy this property, and then you immediately sold this property for $75,000 to the buyer, and then that way you paid the hard money lender back, but you had to pay them a fee to use that money, even if it's just for like 30 minutes. So here's a step-by-step process to closing the deal. Okay, let's go back over everything you've learned. And, you know, and we basically now, you know, you've gotten paid now at this point. You sold it to the buyer. You've gotten your assignment fee. So, hey, congratulations. So let's go through step by step. Step one, find a list of properties. You know, you've got your absentee properties. You've got probate and all the whole list of properties, tax delinquent, fire damage, code violations, all these different lists that you can pull, but you want to focus on one or two lists because remember, everybody's situation is different. Somebody who has just gone through a divorce versus somebody who just lost a member of their family. You do not want to speak to them the same way. Somebody who's a landlord who's not keeping up their property is different from somebody who is going through a foreclosure or a tax delinquency. Those are two different things. And you have to talk to them the different way, the different messaging, the ads are different. So, just understand that when you are doing the work to get out here and communicate with them and have them respond, if you're going to order a bunch of postcards or a bunch of letters, you want to send them to the right people. And just understand that, okay, if I'm going to send this type of letter to tax delinquent people, then I need to send a different type of letter to absentee owners. So you're going to have to run two different campaigns, basically. So just be aware of that. That's why you don't want to focus on too many things. You want to pick one or two because your campaigns are going to be designed around that, and you want your campaigns to be effective. Step number two is you're going to market to the property. So that's what we're talking about. You're going to pick that list, know who that audience is, understand what your messaging is going to be to them, and how they're going to respond to you, and what that process is going to be like. And you make those determinations by choosing what list and what type of person you're going after. The homeowner is going to call you and let you know that they might be interested in selling. You're going to get the details and let them know that you're going to do your research and give them a call back. You're then going to go pull the comps and come up with your maximum allowable offer. You're then going to call the seller back and with your offer, and they accept it. So now you're going to fill out that contract, sign and send it to the owner to sign, to authorize. Once you get that signed contract from the owner that they're going to sell that property to you, you now can start the process by taking it to the title company. And once this contract is recorded at the title company, now you're going to go and market for a buyer. And once you find that buyer, you then agree on a price with the buyer. And you're going to assign that contract over to the buyer. And let me go back up. Possibly you also did a joint venture with another wholesaler to find that buyer. So you might sign a joint venture contract, and the wholesaler now is going to find that buyer and agree on the sale price. And then that contract is going to be assigned to the buyer so they can have the rights to buy the property. And then you're going to send that assignment contract to the title company so that can be recorded, and that way your name and your money goes on that HUD-1 so you can make sure that you get paid. The buyer is going to send their earnest money deposit to the title company. That's that $500 or $1,000. The title company is going to do their title search, and once the title comes back clear, the buyer sends the money to the title company, and everyone gets paid at closing. Go out here, profit and automate. I'm here to hustle and motivate. We're carrying the marathon on. The marathon continues. Keep running your race. Finish your race. The marathon continues.